and we're happy to have you with us today. Today we have a pretty big show to cover here today. We had a wild week in the financial markets. We had a big IPO on Tuesday. We had a lot of earnings going on this week. A lot of the financials have already reported. We're going to get into some of the commodity markets, especially crude oil. To do that with me, I have once again Scot't Maragioglio back on the show. CMT, welcome back, Scott.
Hey, how you doing?
I'm doing really good. It's always great to have you on the show. We talked a lot about your market breadth and just some different technical indicators you like to use in trading and investing. But today we're going to do it a little bit different. We had a big IPO this week. It was Coinbase.
Yep.
Now, there's a lot of people that base their investment strategy on the IPO, what their thought of what it could be, right?
Yep.
Now, there's a couple different types of IPOs, and that could impact prices or could impact things once they do go public and going forward as well. So first off, to start off the show, what is the difference in IPOs?
Okay, so what we're seeing a lot right now are, I'll use Coinbase as an example. It wasn't a traditional IPO. It's called a direct offering. And that's different. Normally what we used to see, now if we went back to say, the last time we had a really big IPO surge was back in 2000. And what would happen is you'd have a company be say a growth company that was up and coming. A venture capitalist would get involved in the stock, kind of like the minor leagues.
Sure.
And then they would bring it along to somebody like a Goldman Sachs or Morgan Stanley. They would do an IPO. They would structure it. They would kind of sponsor it, and for fees. Yeah. And then they would take it out to the public. Now, in that sort of format, typically the valuations would be compressed, and the business fundamentals before they would do an IPO would be going in the right direction, and it would compress the valuation of the stock. And all of this kind of conspired to see the security go higher post IPO. That was typically the thing. So an IPO like that was desirous. You'd want to get it, So, everybody would use whatever influence they had to be able to secure IPO shares because you pretty much knew it was going to go up. A direct offering is different. That's where and this is what Coinbase just did. This is where the company goes directly to the public and offers the shares in a direct offering, also called a Dutch auction, something like that. It's different. An IPO would have shares locked up. Insiders would be locked up. They wouldn't be able to dump their shares. And it's much more of an organized affair. The stock gets defended by the underwriters. A direct offering has none of that. A direct offering is better for the company in a lot of ways because they offer it directly to the public. They get all of the money, right? But there's no lockup.
Okay.
The insiders are not restricted in what they can sell.
So essentially, with the lockup period, the investors can sell or drop their shares right away.
The insider, without a lockup period, everybody can just dump their shares whenever they want.
Okay.
With a lockup, the idea is that the insiders are restricted from selling their shares for a certain period of time, and that helps the share price, again, conspiring to help the share price, go in the right direction. Not having a lockup. So you think about a company like Coinbase, they've got a lot of venture capitalists that were involved in the early stages of the company. They're not restricted. They can just get out of the shares if they want to.
Got it.
Now, the only time this is really going to work well for a company is when there is a really, really high demand for that stock from the public, and that's a bullish thing. Coinbase definitely qualifies for that.
Got it.
Cryptocurrency is a phenomenon, and the speculative energy behind that group is extremely high.
Yeah. So there's a lot of, there's some perks, there's some risks to trading IPOs, right? Actually, Wes is in the chat right now, and he's asking, would you ever day trade an IPO?
Well, typically you can't short an IPO for the first 30 days.
Okay.
So if I was going long, yeah. If I was going short, no. And I really want to have enough data to kind of, start making some choices on price analysis and what's going on. But I mean, yeah, I wouldn't be opposed to it. I might do something with it if there was a good setup, but I couldn't go short if I thought it was going that way for at least the first 30 days.
Got it.
So that's a problem too.
Okay, so just looking at the chart here, I got the chart of Coinbase up right now.
Yep.
With this is a daily candle. So basically, it opened up here at 381, went up to 429. Now we're
Yep.
sitting at 331 right now.
Yep.
So if I were to drop this down to, let's just say, a 1 hour chart,
Yep.
not a whole lot of data to show here, but there's no opportunity as this market has been dropping.
Oh well, the case with Coinbase, I'm looking at a little shorter term chart right here.
Okay.
I think they indicated originally 250, and this
Yep.
thing opened up at 420.
Mhm.
It actually went a little bit higher than that. It just opened up at 420 and has since then collapsed. It fell pretty quick, right down to about 320. And what is this right here? About 311 actually, and it's settled in right now, right about what is this?
330.
330, 332, right in that area. Again, if you ask me, that looks like pressure coming from insider selling.
Yeah.
You're right. So
Because there's no lockup period in this one.
probably. So if I had to guess, right?
Mhm.
So some of these venture capitalists, some of the people who've been waiting, and think about it from their perspective, they've been waiting to get rid of it. They paid, a much lower price for it, and
Yeah.
the public is clamoring for what they've got. This is exactly what you would do.
Got it.
So yeah, it makes some sense that it's kind of stalled out right here. I think snow falls in the same category too.
Yeah. That was about a year ago. Is
Yeah.
that something around there?
Yeah, that stock got beat. It was really hot for a minute and then got beat up. If you check that out.
Got it. No, let's kind of shift gears a little bit. It's earnings seasons again.
Yep.
And there's some pretty big financials that are reporting right now. Yesterday there was Goldman Sachs, JP Morgan, Wells Fargo. Now, there's a lot of people that trade earnings. There's some different techniques based on your objective coming into earnings season, going out of earnings seasons as well.
Yep.
Now, I just want to just recap something real quick here. Goldman Sachs, I mean, they were all pretty good. They all had positive earnings for their report.
Yep.
And Goldman Sachs went up on the day. Wells Fargo went up on the day, but JP Morgan actually went down on the day. Now, as an average investor, how does that happen? Why, if there's great earnings, I mean, a lot of average investors say, okay, I have great earnings, I'm going to go and buy it, but then price went down. What's happening with that?
Well, always remember when we talk about earnings for a company, right? There is what happened. The earnings report is what happened over the last 3 months,
Mm-hmm.
and then there's the sentiment and the idea of what's going to happen over the next 3 months. Like what's going to happen next is what stocks don't move on what typically don't move on what happened previously. They happen on anticipation of what happens next. Move on anticipation of what happens next.
So essentially, the average investor is late to the party if they're trying to buy after great
Well,
earnings.
yeah, right. And what you're trying to do is make sure you check in on what the news is, and you're not thinking it's not as simple as, hey, they had great numbers. That means they're going to have great numbers going forward.
Mm-hmm.
You want to make sure that the business prospects going forward are looking good. I'll give you an example. Like I was just looking at the Citi bank numbers,
Mm-hmm.
and Citi had a great quarter. If you look, it jumped up and kind of came back a little bit on the day. Nothing too dramatic. I mean, the chart overall still looks pretty good. But where they really benefited this quarter was they're behind a lot of the SPACs. These special, if you know what that is, these are in this bull cycle, we're not doing a lot of IPOs like we used to.
Mm-hmm.
Now, where it's like regular growth companies that came up. What we're really doing now is SPACs, special purpose acquisition vehicles, which is really flaky, if you ask me. I mean, this is like a marker of a bubble when you see something like this happening and all these SPACs. Now, Citi's just behind they're loving doing this. They're just pumping out little SPACs. I'm sure they're getting fat fees based on that. But we're seeing a lot of these special purpose acquisition vehicles. And, to my eye, what it really means is these are companies with a lot less going on. They're just ideas about, theme-based,
Mm-hmm.
electric vehicles or, something along those lines.
Yeah.
And-
Go ahead, sorry.
No, go ahead.
Oh, yeah, and when Scott's talking about, I have the chart actually up right now of Citigroup, his price opened up here at roughly $74 and went down on the day, and it had some pretty good earnings. Same thing with, I believe it was Bank of America. They had a pretty decent earnings, and that also went down. So
Right.
It's important to understand how supply and demand really works in the market and not trade the news, trade what is actually happening on the price charts.
Right. And it's the anticipation of what's next. A lot of these companies, the financials, did very well over the last couple months because of what happened with yields.
Yeah.
Right? They've been suffering under extremely low rate environment, and their spreads have been pressured.
Mm-hmm.
So now we're starting to see yields come back up again a little bit. They're getting a little relief there. That's better for profits. And we're also seeing a big increase in mortgages and refinancing
Yeah.
as
So
people are afraid that rates are going to keep going in that direction.
okay, so you kind of open up a can of worms then with yields and bonds and what's happening there. And right now I have the 10-year note up here.
Mm-hmm.
That's been dropping significantly for quite some time here. I got a daily chart up here. What time frame do you want to look on this on the 10-year?
Go to the weekly.
Weekly?
Yeah.
Just talk about what's happening with this weekly chart and some of the reasons why you're seeing these change in yields.
Yeah, if you look at the intermarket picture of what's going on right now, so if you're not familiar with that, asset classes are interconnected,
Mhm.
right? So this is what we call intermarket analysis. The dollar is connected to commodities, commodities are connected to bonds, bonds are connected to stocks, and it's a circular relationship between these asset classes.
Mhm.
And they exert pressure on each other, and they're displayed in the pressure manifests itself in different ways, but that's the general relationships. So what we've seen lately is that bond prices have started to fall, and rates are starting to drift back up again. Now we're not at that critical point yet. Prices were very strong, yields were very very low,
Mhm.
like extraordinarily low. So it's coming back into a range that where that pressure is relenting a little bit. The question is, and what most people have been talking about, is there a reinflation trade, or is inflation starting to come back? And
Yeah.
that's a normal question. We printed, how much money did we print? I think this year, since COVID, we printed, 20% or 25%, some number like that, of
Mhm.
all the money ever printed.
That's
MT,
crazy.
it's crazy. M2 money supply is just shooting straight up, and it was already going up before that, sharply, obviously. So the amount of money they printed in response to this has been phenomenal, and and that's going to manifest itself. That's what we're seeing, the speculative fervor in stocks. The question going forward, though, if you're looking at this from an intermarket perspective, is how is this going to play out? Are we going to see inflation show up? And bond traders at this point are starting to respond to that a little bit. Now, if you look at the weekly chart here, we haven't broken down. There's a supply zone right about there before that big surge up, and it held right there. So we expected it to hold right there, and we saw it move away. So that's a area of demand.
Okay.
If it holds that and drifts higher, then kind of crisis averted for now at least. But if it breaks through that and it gets kind of through that
This
whole
zone,
area
this
right
area
there,
here?
yeah, right there. If it breaks through that whole area right there, then something's really changing. Now, I'm a little suspicious it might. So we're watching this pretty closely, because if we look at the commodity indexes, and I'm looking at the Dow Jones commodity index,
Mhm.
and you can just pull up a chart of crude oil. 'Cause
Yeah.
that'll
Here's crude oil right here.
Yep. The Dow Jones Commodity Index, the weekly chart, is just in a screaming uptrend.
Yep.
It's going straight up. One of the biggest components and biggest reason for that is crude oil.
Okay.
Okay, so let's talk about crude oil a little bit, because crude's at sort of a key inflection point.
Yeah,
here.
before we do that, make sure if you guys have any questions on the view here, post any questions in the chat, and hopefully we can get Scott to answer them as he's talking about some of these different topics.
Yep. So really, for me, if we're talking about inflationary pressure, where that's really going to show up is in the commodity market. So, just looking at a weekly chart of, say, the Dow Jones Commodity Index, it's
Mhm.
just on a screaming move up. That's inflationary.
Yeah.
Now, that's creating pressure. That's where the pressure is coming from on the bond market. That inflationary pressure is pushing on bonds. Whether or not that continues and really kind of rolls bond prices over is sort of the big question. And to me, we've seen copper prices run. We've seen corn. We've seen strength in the softs and the ags. But I'm really looking at crude. And if you go get a really long-term chart on crude.
So here's a weekly. You want to go to monthly?
Yeah, go to monthly, and you can see that the downtrend really started in crude oil. From those peaks back in 2000 and what is that?
2008.
7, 8. And you see that, we've been in a structural bear market ever since those peaks in 2007,
Mm-hmm.
right? And even though these are pretty big moves coming off these lows, pretty significant rallies, they're just a series of lower highs and lower lows within this structural downtrend, right?
Sure.
So we're right at the point right now where if we can get another push up in crude oil, right, that could change that structure that's been in place for the last 13 years,
And that's inflationary.
which is very inflationary, right? So this may be us moving back towards a structural bull market in commodity prices, but we're right on the cusp. We're right on that edge
Yeah.
where we need to see it do the next thing, and then that would be a really big change. Now, if that happens, I don't think I'm not sure how immediately that would translate over to what's happening with the stock market, but that's creating bearish pressure on bond prices. And if it creates enough bearish pressure on bond prices, that's going to start showing up in a withdrawal of liquidity from the stock market,
Which increases the yield.
right? So it's a cycle,
Yeah.
right? So this gets us to the point where, right now, we've got a ton of money coming in. If that money slows, or we start to see it pull back out again, we start seeing competitive assets like bond yields start coming up. That could, that's what will eventually break the stock market. And that's
Sure.
where you're heading to a bear market. It doesn't seem imminent right now, but I'm telling you, a breakout in crude oil would do a big part of starting to send us in that direction.
Yeah, and you're kind of looking at a couple other things as well. On the last time you were on the show, you talked about market breadth.
Yeah.
And so you're saying that you're not seeing those indications right now.
No. So if we look at the market itself, we look right at the stock market, the money flows into the market are still really strong. The money's coming in, and I think you can feel that speculative energy.
Yeah.
You see
The stimmies, everybody had
the
their stimmies.
stimmies check. And yeah, everybody's still buying. I mean, everybody's still going after this stuff, and we start seeing, more of these SPACs coming out, and more. Just think of like those ARK fund type stocks. If those things start to get hot again, or we start seeing some more speculative energy in those companies, this thing seems like it's not really slowing down. The only negative thing I've seen, and it's a shorter term thing, is I've seen a little waning in the small cap index in the Russell, which I'm watching. If the Russell starts to fall off ahead of the other markets, that's a canary in the coal mine kind of situation.
Yeah, well, that's kind of been the lead dog for the last year.
Yeah, on the way up, right?
Yeah.
It really took off, and that's just coming out of this COVID depression, and those companies are domestic, and they do better. The global domestic economy does better. That's why I'm a little surprised they've stalled out here a little bit.
Sure.
But again, that's a shorter term concern. I'm watching it to see if it really manifests into anything. If it does, then that's a signal.
Yeah.
So I want to play to the upside. I still want to play long, but I can see the end down the road, and it's got me a little more cautious.
Yeah. Well, it's just important to be ready for any direction in the market.
Yeah, that's right.
I mean, unlike the IPOs, there's shorting that's available. There's techniques with options in down markets that people like to utilize. So it's just understanding which technique to use at which time.
That's right.
And just putting the lowest risk, the highest reward, the highest opportunity entry points into the market. And that's typically at that or near that turn in price. So appreciate you coming on the show here today. We talked about a lot of different topics here. I do want to have you come on again, talking about just your wide range of knowledge in the financial markets. It goes from options to commodities to the US dollar, whatever that may be. I appreciate it. Thanks for coming on.
I appreciate it.
Thanks.
Thank you.
If you want to see Scott, he actually teaches classes for Online Trading Academy. Actually teaching one here in Minneapolis here this week. If you want to check out more information on that, go to the website on the bottom of the page here. And hope to see you soon again, Scott. As we know, anything we talk about on the show here today, there's no recommendations. This is strictly for entertainment purposes only.